Right, hello everybody, and welcome to today's Trend Signal podcast. It is the 3rd of August 2020, and here we're going to be looking at how to trade the forex and stock markets with our podcast and giving you an update, an overview of what's been happening over the last few days since last time. There's been some big moves on the dollar, big moves on the tech stocks again, equities, particularly in the States, continuing to have a big rise last week. So there really is a lot very much to go through, and as ever, we're joined with Jerry Miller, our Chief Analyst and Chief Executive, who's going to be giving us his views on what's happening. So Jerry, hello to you.
Hi there, morning everyone.
Good. So Jerry, why don't you give us a bit of an overview? Like I said, it really has been a lot about the dollar and probably the tech stocks this week. Earnings season for the tech stocks last week. We talked about that as well, didn't we?
Yeah, it was quite a week really. I mean, a blowout quarter for some of these big tech stocks, the likes of Apple, Facebook, Amazon. Apple up, 10% on its results, Q2 results. Facebook 8%, Amazon 3.7%. I mean, Amazon, God, what is it? $1.65 trillion, something like that. Just an extraordinary outcome. You'd think that rubber band wouldn't be stretched anymore, but stretched it was. But I think the markets, beginning of this week, there seems to be more questions about the shape of the US recovery, and I think that's been reflected in an acceleration in the dollar sell-off, despite the consensus beating forecast from those stocks we just mentioned. I think there is an underlying feeling that the early easing of the lockdown and then the subsequent locking down, as it were, from sort of mid-late June, a lot of investors are now worried about a slowdown in the economy as the southern states have had to do this lockdown, and the data really going forward now will tell us how well the US economy has been faring, and it's a pivotal week this week, Adrian. We've got non-farm payroll and everything else, but gosh, it was an interesting month, I have to say, a really interesting.
Well, that's
month.
The thing, isn't it? Because I suppose often looking at monthly or quarterly numbers. So here we are looking at the month that was, the quarter that was. And it is going to be interesting. When I was looking at some charts over the weekend of the infection rates in the States and just how horrendously managed it's really been in Florida and states like Texas, which have had sort of sharp increases, particularly Texas. Whereas you look at places like New York, which took the brunt of it at the beginning, and in the densely populated area that it is, it's actually fared pretty well. It's been pretty flat more recently. So. Yeah, it can be done there, but they just election year. We've talked about it before, haven't we?
Yeah, Trump was foolishly convinced that it was just the stock market that mattered, but actually the polling suggests that it's not the stock market; it's the mishandling of the pandemic, and there's been a reluctant sort of acknowledgement of that, and I think Trump's tried to goad the Democrats by suggesting the election should be delayed, which will never happen, by the way. But it did go to the Democrats. But of course, the Democrats are goading Trump with the Democrat front runner for the nomination, who is going to be the candidate for the Democrats, Joe Biden. His secret weapon is silence. So, and that's nothing more annoying for Trump than someone who never says anything.
Let the Republicans implode themselves. But you talk about the prosperity of the stock market. I mean, it's not the broad traditional market, though, is it? This is the thing. You look at how, when are we going to talk about the review? But the FTSE got pretty panned last week. The DAX had a pretty torrid time. Whereas, overall, the indices, they fared okay.
The US indices you're referring to, yeah, absolutely, they did. Yeah,
and of course it's not, it's mostly fueled by half a dozen stocks. It's probably a bit unfair, but it's not the broad traditional stock market that I think we're used to. So when people are talking about the US stock market is doing ever so well, it's not necessarily. It's just a handful of stocks are doing phenomenally well, I think, and it's easy to distort the numbers in that way.
Yeah. Well, you've talked about, or we've talked about the big tech, their blowout sort of Q2 results. Look at the so just the moves on the month, quite interesting. The S&P up 176 points on the month, which is 5.6%. They contain all of those big tech stocks. The Dow which is a selective index with 30 stocks it's a price-weighted index, only up 663 points. I say only, it sounds okay, but that's 2.57% compared to 5.6. So S&P more than double. And then you look at the FTSE, down 277. The DAX, pretty much unchanged at minus 33, which is just 0.25%. But the S&P is the standout market. Why? We've just mentioned it, big tech that dominate the S&P 500 and the NASDAQ, of course. And the top 5 companies in the S&P 500 account for 20% of the market capitalization of the index. So you only need those 5 stocks to do what they're doing, and wow, the index is going to be pushed up significantly.
Yeah, exactly. And you know, we've seen some fantastic trades on the back of it. I've not necessarily got a problem with it if it leads to great opportunities. I mean, at Trend Signal, we're not really stock traders per se, as much as looking at the indices themselves and looking at the foreign exchange, and we can see some fantastic accelerator opportunities that we've had on our D1 accelerator for the S&Ps here. And you compare the sort of the high highs, high lows we've been getting there to say the FTSE, which gave us a fantastic short on the 30th. So that's Thursday night. And, you know, so where we're buying those other indices, we're actually shorting the FTSE and, you know, making some decent profits on that as well. And it feels a bit odd going one direction on the S&Ps and the other on the FTSE. But, Jerry, you just explained exactly why that is and why it's happening. And the dollar as well. Dollar's having a big impact. The pound's having a big impact on the FTSE too. So it's not just that tech weighting. It's also the fact that the pound's been having quite a move, isn't it?
Yeah. Well, actually, that sums it up, really. It's a lot of it is down to the relative strength or weakness of currencies. So, for example, last week, the FTSE was down 3.7%. The Dow unchanged. The S&P up 1.75%. DAX down a whopping 524. So the DAX got clobbered last week, 4%. And likewise, the Nikkei. And this is because why? The euro was very, very strong. Sterling even stronger. Sterling, good old sterling. But it's the dollar that suffered with an acceleration in its sell-off. I think, you know, as we've been referring to the questions over the recovery there, and a lot of questions have been asked about the shape of that recovery and the potential, you know, for more monetary stimulus from the Fed, which would weaken the currency even further.
And what's interesting with the euro is that, you know, with our accelerated strategy, I'm just showing the chart here. It's quite a quick, it's quite an active strategy. Not normally in rotations for more than 2 or 3 days. I mean, you can see that previously with the turns earlier in the chart. But we had a buy back on the 1st of July. And we've been in a buy the whole month. I mean, that's just very, very rare that you get that on this strategy. And of course, from 112.51 was the entry. And we've seen up to 119 on the euro against the US dollar. So massive moves on the euro and the US dollar there. And similarly with the pound as well. You know, the last trading opportunity we had was on the 20th of July, 126.5 pretty much, gone up to 131.5. Again, that's about a 500 pip rally in a couple of weeks. So it just goes to show just the relative movement of the dollar over that period. And of course, you know, with the pound rising, that does have that big impact on the FTSE stocks there as well, because they're generally exporting companies pretty much. Okay, Jerry, anything else to cover off on? I guess we can have a quick look at the commodities, can't we? That's for sure.
Yeah, we can do. I mean, just quickly referencing the dollar before we move on. The move in July was 4.4%. So the dollar lost 4.4% of value in 1 month. And this is extraordinary. That's after, you know, June wasn't exactly brilliant, but that's the worst monthly performance since September 2010. So it's
Wow.
Significant. And that was as we were just emerging from the great financial crisis. So it puts it in context. And sterling as well. Sterling, always surprising analysts, both on the downside and now on the upside. And this is a very, very impressive rebound, certainly against the dollar and the euro. But I think what I would say to everyone is that what is not surprising is that sterling remains volatile, which is, you know, sterling pairs, they're great to trade, Adrian.
we've talked about this a long time. They've always been the more interesting pairs, and not only is, I guess, everywhere has got COVID right now, but we've also got the added flavour of Brexit as well. So it's just creating that instability, and that extra movement as opposed to other pairs. So from an opportunity perspective, yeah, there's a lot there in the pound, that's for sure. As there is in gold at the moment, I think we definitely need to talk about that today, as it's just had an insane couple of weeks. The last buy on the accelerator strategy on the 20th of July at 1815 or 1816. Oh, what a ridiculous move. I mean, it's rallied about 1,600 points in about two and a bit weeks. It's insane. Why is it doing that, Jerry?
Wow. Well, yeah, gosh, look at that. So not quite at the $2,000 an ounce level, but very, very close. Gold really continues to benefit from the acceleration in dollar weakness. So with a weaker dollar in euros and in sterling and in Swiss franc and in Japanese yen, gold is not that expensive. And that's the reason why it's been pushed even higher as the dollar weakens. Yeah. So it's benefiting from that. And also it's benefiting from the fact that the US economy has started to wobble. At least that's the feeling. And gold effectively is behaving like a currency, which is typically what it can do, but it reflects dollar weakness. But I would warn you that any snapback in the dollar, i.e. a sudden recovery in the dollar, for whatever reason, whether it's rumors about the Fed not providing any more monetary stimulus to the market, or other things that other announcements that may suggest that things aren't quite as bad as that, as it may look at the moment, that causes the dollar to snap back, it'll also cause gold to snap back. But there is a lot of reference in the press now, a report from Goldman Sachs about questioning the US dollar's reserve status as a global reserve currency. So, but this always happens, doesn't it? It's sort of like the recurring argument and discussion. But I don't think that's going to change anytime soon in the next sort of 2, 3, 4 years, quite frankly. No, dollar weakness is simply down to the fact that the US used to have a good interest rate differential where it paid to hold dollars, but not anymore.
Yeah. Okay, and oil continues to be following the stock market I to a certain extent.
Yeah, it's pretty
a tight range.
Yeah, it's pretty uninteresting, Adrian, really. Tight range. We need more data on the shape of the recovery in the US and global economies. But it's quite interesting to see the difference between the two oils, UK oil being Brent, the global benchmark, and US oil or WTI, West Texas Intermediate, actually being the very domestic focused oil. Last week, Brent was up 40 cents. And you might think, well, what's that got? That's not much, isn't it? And it's not, it's less than 1%. But US oil down 80 cents. So that's down close on 2%. So there is a divergence there. And obviously, there is a concern about the US economy, and any slowdown there will hit the domestic oil market more than the global benchmark.
Yeah. Okay. Yeah, fascinating. So anything else to add, Jerry, before we conclude today's podcast?
Well, we could talk for a long time, but this is that sort of covers most of it. Just an interesting week, and it's going to prove to be a very interesting month to come in August, where a lot of people aren't actually on holiday, believe it or not. So it'll be quite active.
Strange times continue, don't they? And of course, we'll be recording our podcast in a second about the sort of main events for the week. But with non-farm payroll coming up this week, it could really set the tone for the markets for the month ahead. But look, we'll dial out now, Jerry, and then we'll catch up in a few minutes for the next podcast. But everybody, in the meantime, we are hosting some live events this week. If you'd like to learn more about TrendSignal, how we do things here, and maybe actually learn a strategy that you can use to apply to the markets, the foreign exchange, the indices, the commodities yourself, to pick up some of the great trades that I've been talking about in today's session, and make sure you come along and book in for one of our free live events. Now, you should see on screen the link, but I'll read it out as well if you're just listening to us there. So it's bit.ly/learnts. So bit.ly/learnts. Go to that link, register in for a free place on one of our 3 upcoming live events that we've got this week. And we'll teach you one of our favorite trading strategies to help you to identify high probability turning points to help boost your trading results. So in the meantime, everybody, we hope to see you on one of those live events. But if not, have a great week's trading and we'll see you next time. Bye-bye for now.